Hello everyone, it's been a wild month, but before we go on to discuss that, let me ask you, what is the number one question on your mind today? Is it about dollar or inflation or about China, Eurozone energy crisis or geopolitics or any other subject related to domestic macro? Please type in the comment box below and we will try to delve on that next month. Now, coming back to our discussion. A lot has happened last month, that is in September 2022. Some expected and some not. In a total surprise, Ukraine seized back its Kharkiv province, leading Russia to double down on its war in Ukraine. UK saw an enormous fiscal package, which runs counter to the rate hikes by their central bank. UK gilt spiked, pound tanked, UK pension funds were on the precipice of an idiosyncratic crisis and prompted Bank of England to come to the rescue. In India, we had high hopes and associated rally for the bond index inclusion and then the sell-off as the decision gets pushed out to next year. Inflation prints in the US failed to budge, leading to a third 75 basis point hike by the US Fed. Market now expects peak Fed funds rate at 4.5% versus 3.30 until 2 months ago. And yet, growing political pressure prompts a student loan waiver and a pay rise for the rail worker in the US. It raises fear of second round effects on inflation and upside risks to inflationary expectations. Dollar's recent surge has outstripped the performance of practically every currency, leaving RMB to where it stood in 2008, the euro and the yen at the levels last seen in 2002 and 1990s respectively, or as in the case of pound, to all-time historic lows. Global financial market is clearly frayed as dollars surge, equity drops, inflation stays elevated and central banks continue to tighten aggressively, methodically squeezing liquidity from global economy. This makes life difficult for us in India, despite our much better macro fundamentals. INR has fell 9% year to date, much contained than 15 to 16% in our counterparts. RBI has aggressively used FX intervention to slow the pace. Looking ahead, dollar strength is likely to stay. India's external account deficit could moderate a bit in second half, helped by softer crude and moderation in FII outflow. However, it is still a deficit in second half and hence rupee stays under pressure in the near term. FX reserves is likely to drop by another $20 to $30 billion by the end of FY23. But as import bill lowers, import cover could stay protected at 8 to 9 months. Stock markets fell too. Nifty slumped by 4% in September and is down 1.5% year to date. When looked at in dollar terms, Nifty is down 10%, which is still better than 24% fall in S&P and 29% fall in MSCI EM. Hence, India is still an outperformer, perhaps because of the domestic fundamentals which are relatively better. Multiple data points to a renewed strength in Indian manufacturing sector. India's relatively well-placed macro would continue. WPI inflation could soften rapidly. CPI inflation moderation may not be that rapid, but it could fall within RBI's target band 6 months from now. Strong tax collections do not cast any fiscal worry. External debt is even lower than 2013 times and only half of it is dollar denominated. CAD could widen only modestly and RBI reserves could help to avoid a very rapid depreciation. We expect an orderly depreciation in the near term. But as global recession looks inevitable, India's growth could soften and consequently FY24 earnings could see some downgrades. India's valuation premium to EMs is swelling to historic highs. From a near-term standpoint, it could also mean that downside risks to returns remain. Beyond the headline index, however, we find a decent dispersion in stock valuations and hence stock-specific opportunities continue. In the fixed income space, impact of external monetary tightening measures and its spillover effects have been evident in the latest RBI policy, which delivered a third 50 basis point of rate hike. To the extent that these factors prevail over the coming months, the terminal policy rate expectations locally could also be reset a bit higher. Sharp sell in FX to protect rupee has led to a rapid fall in the banking system liquidity, something that we have not seen in for few years now. Continued FX sell and higher currency leakage in the second half of the fiscal could bring the LAF into deficit if the government is slow to spend its cash. As such, short-end rates and credit spreads could rise. Looking ahead, overall focus on moderating surplus liquidity and adjusting policy rates to ensure that the real rates remain positive from a medium-term perspective is a positive aspect. Near-term market action has been surprisingly resilient in spite of external news flows and apparent near-term non-inclusion in some of the bond indices. In the near term, with higher inflation prints and reasonably heavy auction calendar alongside external headwinds, yield could move bit higher. But the thesis for gradual addition to duration holds even as there could be modest uptick in the terminal rate expectation. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.